Sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Howe, in for Jack Otter. Coming up, June jobs coming in higher than expected, but we got hit with another wave of revisions. Wharton Finance Professor Jeremy Siegel has insight on the health of the labor market and what it all means for the economy. And later, cramming in the popcorn while watching for a cinema revival. The summer movie season is off to a hot start with its first major hit. This as theaters desperately try to reel in more revenue with other big blockbusters on the way. But we begin with our expert panel and three things investors ought to be thinking about right now on the Barron's Roundtable. My colleagues Ben Levison, Elizabeth O'Brien, and Jacob Sonnenschein. Ben, I'll start with you. Short July 4th week. What happened with stocks, bonds, hot dogs, whatever you can tell me about?
Well, I just want to dispel one myth here, that there's no such thing as a stock market. What we have are 7 big tech stocks, and they're going up. And so you have the NASDAQ going up 3.5%, hitting a new high, the S&P going up 2% and hitting a new high. And then you have the Russell 2000 small cap stocks. It fell and did not hit a new high and is nowhere close to it. And that's really all there is to the market right now. Big tech goes up, everything else, who cares? And that's what you got.
And those S&P 500 fund holders are still geniuses who saw it all coming with their high weightings in NVIDIA and everything else.
Exactly.
Now, you've been through the jobs numbers from Friday. Good, bad, or neutral?
They lean kind of negative here. I mean, the headline number was great. It was up about 16,000 jobs over the estimate. But then you look at the revision, they knocked off about 100,000 from previous months, and that's not quite a wash. And then you have the unemployment rate rising to 4.1%, bond yields dropping. The bond market may or may not be starting to worry about the economy, but it's not a great number.
Something for everyone to love or not love, it sounds like. Earnings season coming up. What are you watching? What do you expect?
Well, it's going to be a solid earnings season. They're expected to see earnings grow 8.8% year over year. And even the second half of the year, that's expected to be good, too. So we can expect to see some nice guidance from companies. But they better come through with that guidance because so many stocks have gone up this year, not based on their fundamentals, but solely just based on people buying them. That's caused their valuations to rise. And the stocks need to have the earnings that can support that. So we'll be watching next week Pepsi, Delta, some of the big banks like JP Morgan, and the numbers really need to be good.
What you're suggesting is the companies need to actually make more money to justify these prices. They can't just keep going up because they're going up. Have I got that right?
Well, unless they're the big tech stocks, and then who knows?
Okay. Elizabeth, Hurricane Barron, putting aside the human toll, is this something that investors should be concerned about?
Yeah, Jack. I mean, we haven't seen any measurable impacts yet, but from an investor's point of view, what we should be looking for is, the potential impact on insurers like Allstate, on energy companies like Exxon as oil production is potentially affected in the Gulf Coast. Also, on the positive side, home improvement stores like Lowe's and Home Depot could get a boost as people prepare for the storm and then rebuild. Generac, the publicly traded generator maker, is they're even using the severity of this hurricane season in their marketing materials.
Marketing blitz, yeah. We've talked before about how crazy homeowners insurance has gotten in some storm-prone markets. I'm wondering what the effect is going to be on house prices. Could house prices get hit in markets where it's more expensive or more difficult to get insurance?
Yeah, I mean, if insurance costs a fortune, then those homes are going to not sell or sell for a big discount. Get this, my friend in New Orleans pays $17,000 a year for a policy that has a $25,000 deductible. Now, tell me that's not going to affect her ability to sell down the road. I think
difficult. Yeah.
It's going to be a bigger and bigger factor in where people relocate and move to in retirement, potentially.
Right now, you say, what's the house price? What's the mortgage rate? What are my property taxes? In the future, maybe you say, what does the insurance look like that I can get for that?
Absolutely. People are flocking to Florida because it doesn't have a state income tax. You might end up, the homeowners' costs are going to potentially offset that.
Jacob, I've seen some Wall Street commentary about weakening restaurant trends. What are you seeing there?
Yeah, when you look at the sit-down restaurants where you're getting, the more expensive three-course meals and stuff like that, I'm thinking about Outback Steakhouse owner Bloomin' Brands, Dine Brands Global, which owns IHOP and Applebee's. Their revenue is basically fine, and Dine Brands is up a little bit year over year because of inflation, because of prices. Their traffic is down. McDonald's on the large cap side, talked about why inflation and higher rates are now starting to impact the consumer. It doesn't happen overnight. It's starting to happen now. The larger, fast food chains, they have to do a little bit of discounting here and there, so that's bad for their profit margins.
The $5 value meal at McDonald's, the new offering that everyone has seen. But not every restaurant is struggling right now. Which ones are shining, and what do you think they're doing right?
So Chipotle and Cava stand out to me. When you go between the low-price restaurants that cater to more of the low-income households cohort, and then you go to the Bloomin' Brands, which are just full-course, three-course meals. Right in between Chipotle and Cava, they're not so expensive that their traffic is declining. Traffic is growing.
Does everyone know what Cava is? By the way, that's the kind of the newly public. It's the Mediterranean food.
Mediterranean-style Chipotle. Traffic is growing, and they don't have to do discounting because they're right in the sweet spot. You can get a Chipotle or Cava meal for $20, and they're growing, they're adding restaurants, and the digital capabilities are really quite good.
Thank you all. June jobs coming in higher than expected, but a big wave of revisions show that the numbers may not be telling the whole story. Wharton finance professor Jeremy Siegel on where the labor market goes from here. Next. The June jobs report showing a still strong but cooling labor market. And though it came in hotter than expected, we're continuing to get hit with revisions. The economy added 206,000 jobs, above the 190,000 estimate, but down from May's revised 218,000. The unemployment rate unexpectedly rose to 4.1%. That's the highest level in nearly 3 years. Joining me now is Wharton finance professor Jeremy Siegel. Professor, what do you make of the jobs numbers this past week, and where's the economy headed?
Yeah, I think it showed some weakness, really. 4.1%. We are up a half a percentage point or more from the low. Actually, in the past, that has been a warning for a slowdown that leads to a recession. I'm not saying we're getting there, but the downward revisions, the composition of the gains, a lot of it in government, and of course just healthcare. I think we're really seeing quite a slowdown in the economy.
Okay, so how long can the Fed go without rate cuts before the market gets rattled?
I would like it to, sooner rather than later. Minimum, I think that Jay Powell has to tee it up on the July 31st meeting for September. And by the way, if we get a good CPI report and further weakness, I wouldn't mind a 25 basis point cut this month.
By the way, the bond market doesn't seem too terribly worried about the sustainability of the federal debt and deficits. Are you worried?
No, I'm actually not worried. I've looked at the debt trends. They don't really get bad for quite a few years. Sort of the mid 2030s is when they start ramping up. Right now, if you take a look at the debt to GDP ratio and you take out the foreign held debt, which is holding pretty steady, we're really quite in the middle range of all other countries in the world, and actually still well below where we were at the end of World War II. Now, I'm not saying I'm happy with the deficit, but I do not think they're going to be a major factor for yields in the next few years. Stock market concentration is the highest in decades. A lot of artificial intelligence. Is that a good thing or a bad thing going forward? Well, I like AI. I think AI is very promising, but I don't like all that concentration. We've had one of the biggest gaps between the top performing stocks and the rest of the market in history. That has generally, again, served as a warning sign. I really don't think we can probably get those small stocks or value stocks moving until Jay Powell does cut those rates. Okay, so let's say if I'm worried about the NVIDIAs and the Microsofts and what comes next for them, what do I do to diversify? Where should I be looking right now? Well, it's a real question of long run, short run. The momentum is still with these stocks. There's no question that these tech stocks are, as we say, delivering the bacon. They're coming in with earnings, but the bars are high. It's going to be very important for us to look at the earnings season, which of course is right upon us, to see exactly what people say. By the way, first half of this year, GDP looks like it's going to be below 2%, which is actually below the Fed's forecast in December of last year. So, we could stand to lower those high, very, very high short-term rates to give a boost to the economy in the second half.
Way back when people used to watch for a rotation to value stocks, they used to say, you better diversify in overseas markets because, you don't put all your eggs, and so on and so on. But it's only U.S. large cap growth that's been doing well. Are those other themes still important? Should I be diversifying there now?
Well, the problem with foreign markets is basically when you go outside the U.S., you're in what we call a value shop. You're really, those growth stocks, 80, 90% are in the U.S. Actually, the rest of international stocks are not really performing much worse than the value stocks in the U.S. So until you get value going, that's the only time you're really going to get that international going. Now, of course, I think Europe has done pretty well. Japan is really doing quite well. Their valuations are much, much cheaper than the U.S. So I still have positions in them, but I think you've got to be patient.
Thank you, Professor Jeremy Siegel.
Thank you, Jack.
The box office raking in over $1 billion after its first big blockbuster of the summer, but theaters still need more rear ends in seats. Which flicks might do the trick? Next. Theater anxiety is giving way to joy. Disney's Inside Out 2 raking in over $1 billion so far despite a quiet year at the box office. In candy terms, will 2024 be a year of good and plenty with lots of Whoppers and hot tamales, or are we headed for a Sour Patch with Hollywood trying to milk duds? Elizabeth, easy. Elizabeth, I'll start with you. What's making Inside 2 a success?
Well, Pixar has found the winning formula with these human emotions. Disney, of course, owns Pixar, which made the first Inside Out 1 and Inside Out in 2015, and this Inside Out 2, which is the first movie to hit $1 billion since Barbie. It's, breathing life into what had started out to be sort of a lackluster movie season. And, I think it's a good sign for theaters.
Do you think it bodes well for the movie business more broadly?
Yeah, I think it shows that people will show up for movies that they're excited about. People know that they'll be able to stream Inside Out 2 on Disney Plus in a few months for $14 a month, but they're spending that on their ticket plus more on concessions. They're inviting their friends. My son went out to see it with a bunch of his friends this past week. They enjoyed it. Sort of a communal experience. Now, I don't know if people are dressing up as the emotions like they dressed up for Barbie, but either way, I think it's a good sign.
Yeah, by the way, I asked each of you before the show which Inside Out 1 or 2 character you identify with most. I believe we have a graphic. Here's what you told me. Elizabeth, your joy, no surprises there. Jacob, your forgetter Bobby. I can't remember him, ironically. Ben, your anxiety. Our money was on ennui, and I chose anger, mostly because I admire his bold choice of short-sleeve dress shirts. Now, Ben, do you agree with Elizabeth's movie industry optimism, and which releases are you watching for?
Yeah, 3 weeks ago I would have said no, but since we've had Inside Out 2, but we've also had another sequel. Actually, this one's a prequel, A Quiet Place Day 1. That's done a lot better than expected. We've had Despicable Me 4. That's done really well so far. It's expected to hit over $100 million over this long holiday weekend. And so we could ignore things like Kevin Costner's Horizon and American Saga, which looks like it's going to be a stinker. And now we have...
Did Kevin Costner kill cowboy movies, or did he just kill Kevin Costner movies?
Well, I think he killed Kevin Costner movies, but he also made the mistake of not making a baseball movie, because that's all anybody wants to see Kevin Costner do. But we have also these other movies that are coming. We have Deadpool and Wolverine. We have Twisters. We have Gladiator 2. We have Beetlejuice. We also have a second Moana. And, if you can sense a theme here, these are all sequels, but if they can actually deliver the goods, I'm looking at that second Moana movie and probably that Deadpool and Wolverine as being the big hits there. But, yeah, you could keep this box office going.
Jacob, what do you think it means for studio stocks?
Yeah, when you look at Disney, first of all, and Ben just mentioned Deadpool, Disney has a great library of content that it's had for decades and decades and decades. So they have that there going forward. They also mentioned, the company mentioned on the last earnings call that it can build off of that, do sequels, and sequels are pretty profitable, more profitable because they don't require a lot of marketing spend because you already know what the idea is about. And so going forward, that's going to help the profitability of the streaming business.
I'm starting to view Netflix as the Death Star of show business because I'm wondering if any of the legacy players can keep up on free cash flow and content spending. What do you think?
Yeah, it's going to be tough to keep up. I mean, but Disney is a huge company that is profitable with tons of cash. But what Disney has to do is get through this period of billions of dollars of investment, probably some price wars here and there, which we have seen in the past few years in terms of streaming. They're eventually going to get to profitability, but they're going to get to like 10% operating margin, profit margins in the next few years. Netflix is at 26%. That's going to be tough.
Yeah, I mean, I think Disney is well positioned from a cash flow perspective. It's got, of course, the merchandising, it's got the parks, it's got cruises. It's more than doubling its cruise line capacity over the next 2 years. So that's sort of good from a diversification point of view.
Okay, we touched on studio stocks, Ben. What do you think this means for movie theater stocks?
Well, if you're Cinemark, this is great. Your stock's up 53% this year. Everyone's excited about actually, you know what, we don't have to wait for 2025. We're actually getting some good movies this year. If you're AMC, you know, the meme stock that everyone got excited about.
Yeah, how do you figure that out? The meme trade versus what's actually going on in theaters?
Well, they're actually doing okay business-wise. They're taking market share and whatnot. The problem is they have this massive debt load that they have to pay back. The meme trade has actually helped on that front because it allowed them to buy back or pay off some of that debt and to refinance some of it. But they still need all this cash flow to come through so that they can pay the debt down. And it's going to take a really good rest of this year and a fantastic 2025 for that to happen.
I hear the Paramount deal is back on. Initially, there were concerns that it was kind of a sweetheart deal for Sherry Redstone. Is the new deal any better for shareholders?
Well, I think it's better for Sherry Redstone. If I mean, none of this
How does that happen?
All this has been reported by the likes of the Wall Street Journal, but supposedly there may be more protections for her in case shareholders sue over the deal. You know, this kind of seems like a last resort kind of deal. Like Paramount is not doing well. It's a fraction of, I mean, even I think it's about a 10 billion market cap, which is about, you know, 18 billion for Warner Brothers Discovery. Warner Brothers Discovery is not doing great. So, I mean, they really just need to get a deal done.
Quickly tell me about one upcoming movie that you might see.
I want to see The Crow. I liked the first one. I'm all for goth movies with a lot of action.
Jacob.
Smile 2, it's horror. I like to scare myself.
Elizabeth.
Okay, Wicked, it looks, with Ariana Grande, it looks like a fitting successor.
With the Green Witch.
Exactly, yeah. It looks charming.
Wicked, okay. And I might see Deadpool and Wolverine. They say that those two can't be killed, but let's see what the box office does. Thank you all. Coming up, Elizabeth and Jacob have a pair of stock ideas, and Ben's going to nerd out for Forex fans with a dollar trade. Stay right there. Ben, let's nerd out on this one together. Now, there's a hot new currency trade called the G10 carry. Tell us about it.
Well, Wall Street loves easy ways to make money, and there's no easier way than borrowing in one low rate and then buying a higher yielding bond. It's great. So normally this requires a lot of risk. You borrow in something like the yen, and then you buy a Brazilian real bond, or you buy a Mexican peso bond. And at some point it blows up. But these days what they're doing is they're borrowing in the yen and they're buying the US dollar. And this is great because you don't have to take the risk of being in Mexico or Brazil or in India. You're in the US. And what's great about this as well is that the dollar just keeps going up. So not only are you making that extra 5% interest on this, but you're also watching your currency appreciate. And this is what Wall Street loves. And it is great until, of course, something happens that causes the dollar to drop and other rates to go up.
Here's hoping it's not the new peso.
It's not the new peso.
Okay.
No.
All right. Well, by the way, it's not just Forex traders who are cashing in on this. Trips from the U.S. to Japan are booming right now. Prices in Japan in dollar terms are down 1/3 from 5 years ago. So book your trips. Jacob, give us a stock pick. You like onsemi. That's not the sneaker company On. That's a different On. This is onsemi. What do you like there?
onsemi is a chip maker. It gets the biggest bulk of its revenue comes from selling chips to automakers. That's why the stock is down double digits from its all-time high, because the auto business has slowed down significantly. Production about flat for year over year recently. That's showing signs of turning the corner. At this point, you know, auto producers are going to need a few more chips. When you go long term, you look at the next 5 to 6 to 7 years. as on sells chips to electric vehicle makers, those chips are at higher prices, they have higher margins, earnings go way up, and the company buys back stock.
Elizabeth, you're almost dressed in blue oval color from Ford. It's because you like Ford stock, right? What else do you like about it?
I do. You know, Ford is lagging rival General Motors, although sales are up at both. Analysts expect Ford to close the gap by trimming EV spending and also focusing on shareholder dividends.
I know you've told me that you're a non-driving New Yorker, but if you had to buy either a Ford F-150, the Lightning one, electric, or one of those fancy Tesla Cybertrucks, and Ben's paying, so you don't have to worry about the cost, which one are you taking?
Not the Cybertruck. I would say yes.
You're
definitely.
going with the
I'm
Ford.
going with the Ford.
Got it.
Absolutely. Cybertrucks are goofy.
Ben, Elizabeth, Jacob, thank you all. To read more, check out this week's edition at barrons.com. That's all for us. See you next week on Barron's Roundtable.